No one can predict the future with total certainty. But when it comes to investing, you can significantly improve your odds of long-term success via factors of return. Not all stocks or bonds are created equal. Certain characteristics or factors have been identified by extensive research as offering the potential for higher returns over time or reduced risk. To identify these factors, we rely on 9 decades of data and research and the work of noted academics, including 12 Nobel laureates. Just as healthy diets depend on the right nutrients, portfolio returns depend largely on the right factors. So, what is a factor? Think of a great athlete. More than likely, what makes her great? Agility, persistence, strength, flexibility, speed. These are the factors of her success. Similarly, investment factors help power your portfolio. And behind many of these factors is the essential relationship between risk and reward. In order to earn greater returns, you have to take more risk. Think about a high diver. His score is significantly determined by the complexity of his dives. If all his dives are safe and easy, he will never win. He has to complete more challenging, riskier dives in order to be in medal contention. Similarly, higher returns are largely a function of greater risks, but not every investment risk is worth taking.
At Symmetry, we've identified 8 different factors of return we believe should be in most investors' portfolios. These include market. Stocks will tend to outperform bonds. Size. Small company stocks tend to outperform those of larger companies. Value. Cheap stocks and bonds tend to outperform expensive stocks. Momentum. Stocks and bonds that outperform in the near term tend to continue to do so. Quality. Quality stocks and bonds of high-quality companies tend to outperform those of low-quality companies. Minimum volatility. Minimum volatility stocks tend to offer better risk-adjusted returns than high-volatility stocks. Shorter maturity and lower volatility bonds tend to have better risk-adjusted returns than longer maturity and higher volatility bonds. Interest rate risk. Bonds with longer durations or maturities tend to outperform shorter-term bonds. And credit risk. Bonds with lower credit quality tend to outperform bonds of higher credit quality because not all factors outperform all the time. Factor diversification is just as important as asset class diversification. Instead of guesswork and speculation, the financial science of factors can provide a solid foundation for a better long-term investment experience. For more information, visit symmetrypartners.com.